You ever wonder what really separates a company that's just making a profit from one that's a truly great investment? It's not always about what they make, but how efficiently they make it. And it all comes down to this one critical idea: efficiency. Today, we are going to unpack the one financial ratio that I think measures it best. So here's what we're going to cover. We'll start by looking beyond simple profit. Then we'll break down ROCE itself. We'll tackle the whole leverage question with ROE. Figure out what a good ROCE even looks like. Face the ultimate test, which is WACC. And finally, we'll talk about its limits. Let's get into it. All right, so let's just jump right in with a big question. Is a company that makes a profit automatically a good business to invest in? You might think so, but the answer, well, it's not nearly that simple. Okay, picture this. You've got two companies, Company A and Company B, and they both report a cool $1 million in profit. On the surface, they look exactly the same, right? But what if I told you that Company A needed $10 million of capital to make that profit, while Company B only needed $2 million? Suddenly the picture changes, doesn't it? Company B looks like a way better business. That right there is the power of efficiency. And that is precisely the question that Return on Capital Employed, or ROCE, is designed to answer. It just cuts through all the noise of those big, absolute profit numbers and gets right to the heart of the matter: efficiency. It tells us, plain and simple, how much bang for the buck a company is getting from the total pool of money it has to work with.
So how does this efficiency engine actually work? Let's pop the hood, and really break down the formula piece by piece.
First up, you've got the top part of the fraction, operating profit, or EBIT. This is a company's profit purely from its main business, making and selling its stuff. By looking at earnings before interest and taxes, we get this really clean, unadulterated view of how well the core business is running without getting distracted by how the company is financed or what its tax rate is. Next up, the bottom of the fraction, capital employed. Now this represents the total pot of long-term money the business is using to make that profit happen. And it's not just the owner's money. It includes all the long-term debt too. The easiest way to think about it? It's the total fuel in the company's tank. Now, what's really cool here is that you can actually get to this number from two completely different directions. On the left, you've got the asset-based view. Basically, what stuff does the business own to operate? And on the right, you've got the financing-based view. Where did all the money come from to operate? They're really just two sides of the same coin, and they should both tell you the total capital at work. So, you put those two pieces together, and the formula is just beautifully simple. It's the operating profit divided by the capital employed. That one number tells you how much profit the company wrings out of every single dollar invested in its operations. Okay, so right about now, some of you might be thinking, hang on a second, isn't there another ratio called return on equity, or ROE? And that is a fantastic question, because when you put ROCE and ROE side by side, it reveals a really critical story about how debt can create a powerful and sometimes dangerous illusion of profitability. The key difference, as you can see in this table, it all comes down to one simple question. Whose money are we talking about? See, ROCE looks at all the capital, money from both lenders and owners. ROE, on the other hand, it focuses only on the return to the owners. And believe me, that distinction makes all the difference. Let's take a look at this first company. It has very little debt, its ROCE is 15%, and its ROE is right there with it at 16%. They're pretty much telling the same honest story. What you see is what you get. The business's return and the owner's return are basically in sync.
But now, watch what happens when we introduce a whole lot of debt. The company's core operational efficiency, its ROCE, is exactly the same at 15%. The business hasn't gotten any better, but look at the ROE. Whoa, it skyrockets to 30%. It looks twice as profitable to the shareholders, but the underlying business hasn't changed one bit. That's financial leverage, and while it can juice up returns, it also adds a whole lot of risk. ROCE sees right through that.
Okay, so we've got our ROCE number. We know how to calculate it. But what does it actually mean? What makes a number good? We've got to put it in context.
So, what's a good number? Well, a lot of analysts will tell you they like to see something north of 15 or 20% as a general benchmark. But honestly, the real story isn't in a single number from a single year. It's all about the trend. Is that ROCE stable or even better? Is it climbing year after year? That is the sign of a really well-managed company. And you have to remember, context is absolutely everything.
You just can't compare the ROCE of a giant steel manufacturer to a nimble software company. It doesn't make sense. Different industries just need different amounts of capital to run. The only comparison that's truly meaningful is against a company's direct competitors. A 15% ROCE might be amazing in one industry and pretty terrible in another.
And now we arrive at what I think is the most important part of this whole analysis. Because a good return isn't always good enough. The real ultimate test for any business is whether the return it generates is actually higher than what it costs to get that money in the first place.
Think about it like this. A 15% return sounds great on paper, right? But what if it costs that company 16% on average to borrow from banks and raise money from shareholders? Well, in that case, for every dollar they invest, they're actually losing a penny. That supposedly good return is actively destroying wealth.
This cost, this hurdle rate, it has a name. It's called the weighted average cost of capital, or WACC. Just think of it as the blended average interest rate the company pays on all its financing, both the debt and the equity. It's the break-even point. It's the absolute minimum return the company has to earn just to keep its investors happy. And this simple comparison right here, this is the moment of truth. This is the whole ballgame. If ROCE is greater than WACC, the company is creating real, tangible economic value. It's a wealth creation machine. Tech. But if ROCE is less than WACC, I don't care if it's profitable on paper, it is fundamentally destroying capital. That is the definitive test of a great business.
Now, as powerful as Rocky is, we have to be honest. No single metric is a silver bullet. It's so important to understand its limitations and the spots where it can be a little misleading.
You have to remember ROC has blind spots. For one, it's always looking in the rearview mirror. It's based on past performance, not future potential. It can also get skewed by accounting quirks like really old, fully depreciated assets that can make a company look more efficient than it really is. It's also pretty much useless for analyzing banks or financial firms. And most importantly, it's just one piece of a much larger puzzle. It doesn't tell you anything about growth or cash flow or competitive advantages.
But even with all those caveats, we always come back to this central truth, that positive spread, that simple little gap between what a company earns on its capital and what that capital costs. That is the critical benchmark. It's the bright line that separates the businesses that truly create value from the ones that are slowly but surely destroying it.
So, the next time you're analyzing a business, don't just ask, is it profitable? Ask the better question. Is it an efficient creator of value? Ask if its ROCE clears its WACC. Now that you know the ultimate test of business efficiency, how are you going to look at your next investment?